Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The document we're exploring today is titled Market Report, SpaceX IPO, Macro Data, and Tech Rebalancing. This video presents a direct informational narration of the source document. So diving right into the source document, it kicks off by analyzing Friday, June 12th. That's the day of the highly anticipated SpaceX public listing, and man, it absolutely captured the complete focus of the broader market. Right out of the gate, the initial trading session showed some phenomenal market enthusiasm. We're talking about an intraday surge of over 30%, hitting a peak of $176.32. Now, even though those gains narrowed a bit toward the close, the stock still finalized the session incredibly strong at $160.95. With that closing price, the company's valuation skyrocketed to an unprecedented $2.1 trillion. To put that massive number into perspective within the broader US market, there are literally only 5 other companies, NVIDIA, Apple, Google, Microsoft, and Amazon, that currently sit above that $2 trillion threshold. And according to the document, this immense concentration of capital actually created a structural liquidity drain on the rest of those magnificent 7 peers. It essentially left these previously dominant tech names facing drastically reduced trading interest and capital allocations, as funds rapidly rotated into the new listing. At the same time, this initial public offering drove some serious wealth generation for SpaceX personnel. Data calculations from Hill.com show that roughly 4,400 current and former employees just achieved millionaire status. And of those, about 400 individuals are now holding stock valued at over $100 million. Plus, through this listing, Elon Musk officially became the world's first individual with paper wealth exceeding $1 trillion. Another wild detail here is that over half of the employees actually continue to increase their holdings during the IPO process, bringing the total employee reinvestment capital to nearly $1 billion. Now, despite all the ongoing debates we heard prior to the listing about potential valuation bubbles, market demand unequivocally crushed those concerns. The capital breakdown illustrates that about $15 billion was sourced from retail investors, while a massive $60 billion originated from institutional capital. What this structure reveals is that a substantial portion of both institutional and retail participants failed to secure sufficient initial allocations, which created an immediate demand for covering positions. On top of that, the mandated inclusion into the NASDAQ 100 introduces almost automatic buying pressure for the first 15 trading days. For a newly listed, highly scrutinized asset, this severe supply and demand imbalance serves as a primary driver for further price appreciation. It essentially establishes a rapid buy-the-dip mechanism on subsequent pullbacks. Because of this immediate capital velocity, multiple ETF issuers have already rushed to launch double-leveraged bull and bear products linked to the stock's performance. Additionally, individual stock options are officially scheduled to open for trading next Tuesday. These structural derivative developments are a huge signal that subsequent price volatility is highly likely to increase. Basically, short-term price action is going to be heavily influenced by sentiment-driven momentum rather than just purely underlying fundamentals. For market participants seeking exposure to the broader commercial aerospace sector, identifying secondary beneficiaries is a super common strategic requirement. The document points out that certain trading platforms offer specific aerospace theme tracking functionalities. This helps consolidate core companies within the sector so you can monitor relative strength and sector-wide trends. And given the anticipated volatility following the SpaceX listing, the source details the utilization of advanced risk management orders. Features like a trailing stop loss, for example, automatically adjust protective thresholds upward as the asset price increases. Similarly, stop limit and take profit limits allow participants to predefine their exit parameters. This systematically manages risk without the absolute necessity of continuous monitoring. The document also briefly outlines some ongoing platform promotions. There's a Canada Top Trader competition featuring a prize pool of over 1 million Canadian dollars, with top individual rewards surpassing 100,000 CAD. Then there are account deposit tiers offering specific incentives. Depositing $1,000 yields 10 free stock draws, while an $8,000 deposit bumps that up to 30 free stock draws, which may include popular equities. For U.S. users, the rewards include up to $1,000 in NVIDIA stock and an 8.1% annualized percentage yield on idle cash. All right, transitioning over to the macroeconomic data. U.S. markets experienced an upward session which was supported by easing geopolitical risks and increased risk appetite following the SpaceX listing. But the macroeconomic indicators also provided some solid support. The preliminary reading for the U.S. June Michigan Consumer Sentiment Index recorded a 48.9. That significantly exceeded the market expectation of 46, and it's up from the previous reading of 44.8. This improvement correlates nicely with the recent decline in crude oil prices, which has definitely alleviated some consumer economic concerns. Simultaneously, the preliminary U.S. June one-year inflation expectation decreased to 4.6%, sitting materially below the anticipated 4.9%. So you've got this dynamic of recovering consumer confidence alongside declining inflation expectations that serves as a really positive fundamental catalyst for risk assets. Geopolitical developments are continuing to influence macro positioning as well. The Prime Minister of Pakistan stated that the United States and Iran have reached an agreement on the text of a peace treaty, suggesting a final memorandum of understanding is near. Additionally, Reuters reported that the United Arab Emirates has agreed to release up to $10 billion in funds to Iran, though other sources indicate the total could actually reach $20 billion. This capital release is reportedly structured in exchange for Iran halting attacks on the UAE. And according to Iranian media regarding the new agreement, navigation through the Strait of Hormuz will gradually return to normal over the next 30 days. That really eases structural concerns over potential crude supply disruptions. Touching on specific energy supply dynamics, the U.S. Energy Secretary noted that approximately 7 million barrels of oil and fuel are currently transiting the Strait of Hormuz daily. That represents about half of the backlog volume from the early stages of the conflict. Crucially, the Secretary also confirmed that the U.S. will not implement oil export bans to artificially suppress prices. Consequently, WTI crude oil futures declined nearly 4%, falling below $85 per barrel. This reduction in energy prices supported a broader decline in Treasury yields. We saw the 10-year U.S. Treasury yield drop back below the 4.5% threshold, thereby providing some great structural support for the equity market rebound. Now, in terms of technical market structure, the S&P 500 index encountered resistance upon reaching its monthly moving average. It formed a daily doji candle positioned precisely between the 5-day and 20-day moving averages. Basically, that indicates a temporary equilibrium between buyers and sellers. But notably, despite recent index declines, market breadth showed improvement. This internal divergence signals a healthy rotation rather than a structural trend reversal. Capital is rotating internally rather than just exiting the market in a synchronized sell-off. This behavior suggests institutions are systematically taking profits on extended, high-profile assets while establishing positions in new macro themes, which really fortifies the base for future upward movements. That V-shaped reversal we observed on Tuesday, which was followed by Thursday's strong advance, was heavily influenced by some historic capitulation within the options market. Trading volume for put options on QQQ and SPY experienced unprecedented spikes. QQQ put volume temporarily reached 7.4 million contracts, while SPY put volume hit an extraordinary 11.2 million contracts. This massive influx of protective put buying initially accelerated the broader market decline, but it subsequently established the exact conditions for a violent snapback rally. In technical analysis, extreme put volume peaks frequently align with short-term oversold bottoms, and while the VIX remains elevated above 16, indicating ongoing potential for high-level consolidation, this capitulation event effectively cleared out weak positioning. Shifting gears to index rebalancing, the Nasdaq announced the results of its quarterly Nasdaq 100 adjustments. 5 companies are going to be added to the index: 3 AI infrastructure equities, which are ALAB, CRWV, and NBIS, 1 space sector stock, RKLB, and 1 robotics company, TER. These will replace CHTR, CTSH, INSM, VRSK, and ZS. This structural adjustment becomes effective prior to the market open on Monday, June 22nd. As the document outlines, this rebalancing clearly illustrates a shift in core index composition, officially prioritizing AI infrastructure, the space economy, and robotics, while traditional software and service sectors are rotated right out. As a direct result of these index inclusions, ALAB's stock price achieved a new all-time high. Serving as a core beneficiary of AI network switching chips, the company continues to experience sustained institutional accumulation. CoreWeave, trading as CRWV, utilized this catalyst to rebound as well, briefly testing the $105 resistance target. Passive capital flows may continue to support the price toward the 115 level prior to the June 22nd inclusion date. Similarly, NBIS presents a comparable technical setup. It's demonstrating significant structural repair after a nearly 28% drawdown, indicating a potential return to its previous high-volume zones. While the Philadelphia Semiconductor Index posted consecutive gains, major global financial institutions, including Citi, Goldman Sachs, JP Morgan, Bank of America, and UBS, are actually initiating measures to tighten financing costs and limit leverage on Asian semiconductor leaders. Specifically, they're targeting SK Hynix and Samsung Electronics. This coordinated restriction on new leveraged positions acts as a moderate cooling mechanism. From a macro perspective, reducing excessive leverage prevents uncontrolled speculation and is generally viewed as beneficial for the sustainable long-term trajectory of the semiconductor sector. Looking within the commercial space sector, the SpaceX listing generated a pronounced siphon effect. It resulted in severe capital outflows from broader space-related equities as liquidity rotated directly into the undisputed sector leader. This dynamic triggered a 9.4% drop in the NASA Space ETF, alongside a synchronized sell-off across retail-favored space concepts. Essentially, SpaceX is rapidly establishing itself as the primary valuation anchor for the entire industry. However, RKLB remains a structurally sound asset, presenting logical accumulation zones around $100, with lower scaling targets at 90 and 80. Additionally, MNTS announced a new $25 million stock offering following an $84.6 million raise in May. That indicates an aggressive capacity expansion strategy that simultaneously dilutes short-term shareholder equity. When analyzing the secondary beneficiaries of the SpaceX IPO, Google emerges as a significant stakeholder. The company maintains an approximately 4.9% stake in SpaceX, a holding currently valued at over $105 billion, marking one of its most successful private equity investments ever. But despite this massive unrealized gain, Google's proprietary stock is experiencing sustained capital outflows. Institutions are indiscriminately liquidating positions across the Magnificent Seven, including Google, just to secure the necessary capital for participating in the SpaceX trade. Amid this distribution, the $350 region serves as a critical structural support level for Google to maintain its long-term ascending trend. In individual equity action, NVIDIA demonstrated relative technical weakness. It traded below its 50-day moving average for 3 consecutive sessions, indicating short-term capital diversion toward the SpaceX listing. Critical support resides at the $200 and $193 levels to preserve its macro uptrend. Conversely, Roku surged over 20%, following reports of early-stage acquisition discussions with a U.S. media entity. Meanwhile, Adobe shares declined 6.8%. Despite exceeding Q2 revenue expectations, the sudden departure of the CFO to Marvell Technology, right following the CEO's announced retirement, definitely triggered leadership stability concerns. Finally, Intel, representing the legacy AI hardware segment, showed some resilience by nearing its prior highs. So as the upcoming trading sessions commence, market focus will pivot aggressively away from the SpaceX IPO and geopolitical optimism toward the impending Federal Reserve meeting and the Bank of Japan's rate decision. These events will fundamentally reprice interest rate pathways, economic outlooks, and macro liquidity expectations. Until these central bank decisions are finalized, market sentiment is anticipated to oscillate violently between risk aversion and risk-seeking behavior. The overarching conclusion from the source document is that while the recent rebound demonstrates internal structural health, the market is quickly approaching a critical macro stress test. Consequently, conservative positioning and disciplined risk management remain the most prudent structural approach as these liquidity dynamics are recalibrated.